Hi everyone. So a lot of things are happening in the market the last week, and really quite interestingly and excitingly, we're at a point right now where a lot of the things we've been working on over the last 5 months or so, really going back to July, are really all starting to come together really nicely. And we're going to review a bunch of that today and kind of think about what it all means. But before we get too far into the video, I want to remind everyone to please remember to subscribe to the channel, like the video, and share it with your friends so we can continue to grow as we enter 2026. But just to quickly start off and recap, the S&P 500 did rise this week by about 71 basis points. But a lot of this we're gonna see is gonna begin to change, I think, as we start moving forward. And a lot of that is because firstly, we're seeing a lot of stress and strain in liquidity when it comes to the market. So we've seen basically over the last week, the TGA, which is the Treasury General Account, really rise towards that $1 trillion mark. Now, Monday, we're going to be getting the quarterly refunding announcement, and we're going to find out there where the Treasury plans to keep the TGA for the end of the quarter and going into the first quarter of 2026. The TGA was earmarked to finish December at $850 billion, which would suggest right now the TGA is probably a little bit overfunded by about $150, but we also have the government shutdown right now, which is probably causing a little bit of a buildup there. Now, it's possible that Treasury could keep, the target still at $850 billion, or it could be that case that where they're going to potentially maybe raise that number towards, let's say, 900 or 950 billion. Could even be $1 trillion. It really depends on what the government outlays are expected to be. Remember, the Treasury tries to keep about 1 week's worth of outlays available. And then, of course, that's really led to a drain in reserve balances. We saw reserve balances this week fall to 2.8 trillion. And it's likely that they fell even further. I have my own running tally that gives me a sense of where reserve balances are on a daily basis. And right now, I'm estimating they're probably about $50 to $100 billion less than where they were on Wednesday when that last number was tallied. My numbers tend to run a little bit lower than what the actual number is, so it could be that we're closer to 50 billion, under 50 billion lower than what the 100 billion number that I'm showing on the screen. But the point is that we've continued to see that liquidity get sucked out of the market, mostly because you have continued to see the TGA continue to rise. And for that matter, because it's continuing to rise right now, that's creating a lot of strain in the overnight funding market. We can get that sense really by just looking at the standing repo facility. This number is reported by the New York Fed 2 times a day. The first time's at 8:30 a.m. Then there's another window where you're allowed to access this facility. The data is released at 1:45 p.m. And on Friday alone, $50 billion was accessed, basically because we saw funding rates trading above the upper end of the Fed target rate. So right now, the way this works is that the Fed target rate is 4%, and if the general collateral rate in the marketplace is trading higher than in that 4%, and institutions need to access liquidity, they can do so by going to the New York Fed and accessing the standing repo facility. And they put their bids in, and then they get allocated an amount. And essentially, we saw the biggest total at the standing repo facility. You have to go all the way back really to COVID to find a higher number. One thing we are seeing is the general collateral rate actually going much higher. And it came down on Thursday, but it's important to remember that the Fed cut rates on Wednesday to 3.25% to 4%. So the fact that the general collateral rate came down to 4.1% isn't really an indication that things were better. They were better from the standpoint of they weren't as high, but they were still 10 basis points higher than where the effective funds rate was. Now on Friday, that same rate spiked to 4.29%. So the Fed, the way it works is you have a target rate between 3.25% and 4%, but the actual effective funds rate is somewhere in the middle. And right now, that effective funds rate is around 3.87%. And so on Thursday, even though that rate came down to 4.1% and that resulted in the SOFR coming down to 4.04, you were still trading 17 basis points above the effective funds. And another measure you can use to kind of get a sense of how tight liquidity is is interest on reserve balances. And this, again, is a rate that the Fed sets. And as of Friday, that rate was down to 3.9%. And with the overnight general collateral rate trading at 4.29%, according to the data from DTC, that meant that you saw basically the effect that the overnight general collateral rate trading nearly 39 basis points above the interest on reserve balances, which tells us that there is a lot of stress right now in the overnight funding market. This stress will pass on Monday. It will begin to ease because it was a month end and it was also a Treasury settlement date. And so typically around Treasury settlement date, we will see usage of the standing repo facility increase because there's extra stress in the marketplace. There's an extra need for liquidity because the Treasury is essentially draining liquidity when there's a settlement date. And so this will ease a little bit next week because next week we have 2 settlements, but they're going to be smaller than what we experienced this past week. This past week, we had over $110 billion drained out of the marketplace through Treasury settlements. Next week's only looking to be around $50 billion. And so while there'll still be some liquidity drain, that will ease. Also, we won't be at month end, so banks will be able to begin to ease up on their balance sheets, and that should also help to bring the general collateral rate down. But in the meantime, what we saw on Friday was a lot of stress in the market. And truth be told, this is going to continue to be an issue as long as the TGA continues to rise, as long as the Fed continues with QT. And the really important point here is that we know that the Fed is going to continue QT at least until December 1st. And so the question really becomes is where is the TGA going to be? We'll find out on Monday, because if it's 850, if they decide to keep it at 850 billion, then we know there will be $150 billion probably released from the TGA, which will help to relieve reserves a little bit and push them back up closer towards that 3 trillion mark. Now, the bigger problem, though, is that until the Fed really begins to expand its balance sheet, which may not really even happen until the first quarter of 26, maybe even the second quarter of 26, because Chair Powell may decide that, you know what, he's only going to be here for another 4 or 5 months. Let his predecessor kind of decide what they want to do with the balance sheet and let him just kind of, ride off into the sunset. That could very well be an option. And so I think that there's some questions around when the Fed may actually begin to ease up on the balance sheet. So from a liquidity standpoint, there's a lot of things going on in the marketplace right now that are really important. And so to kind of illustrate how the reserve balances play into the marketplace, they play in a lot of different ways. So what I did here was I took the VIX index. I then took it and looked at it on a 50-day exponential moving average, and then I inverted it. And what we'll do now is we'll hide the actual underlying VIX. So all you see is the VIX 50-day exponential moving average. And then what we're going to do is we're going to add in reserve balances held by the Fed. And what you see is that as the direction of reserve balances goes, it tends to have an impact on the direction of implied volatility. And what we're seeing right now is that the liquidity that's being taken out of the marketplace, reducing reserve balances, could very well increase implied volatility in the marketplace. And it makes sense from a mechanical standpoint. When there's ample liquidity, it tends to dampen and suppress volatility. And when liquidity begins to thin out, it tends to increase implied volatility. And so it makes sense in a lot of ways if we began to start seeing more volatility in the marketplace as a result of reserve balances coming down. Now, remember, this is a 50-day moving average. And so what you're seeing right now isn't really a true representation of where the VIX is at this moment. The VIX would have to start rising in a more material way for the 50-day exponential moving average to start going higher. And so right now where it is, you're not really seeing that yet. And it's possible that that still has to come. Also, when you take something like high yield credit spreads, you also see a similar type of relationship. So this is the B of A ICE high yield option adjusted spread. also inverted. Very similar characteristics because out of the VIX, because implied volatility and credit spreads tend to move together. In fact, if I invert this and then I hide the reserve balances and add in the VIX index, what you'll see is that the VIX and high yield credit spreads tend to move in similar directions. When implied volatility is coming down, typically you see tight credit spreads. And when implied volatility is rising, you tend to see credit spreads widen out. And so again, this isn't really all that surprising to me to see that when reserve balances are declining, you're also seeing some stress forming in the overnight in these credit spreads. So this is something else that we need to continue to keep an eye on. Additionally, you haven't really seen the impact at this point yet in the S&P 500, simply because I think the index is somewhat skewed given that the way the weightings are in the marketplace with Nvidia and the likes kind of leading the charge. But when you look at the RSP, for example, you can see that relationship becomes a little bit tighter. It's certainly not a perfect relationship, but there is one that is there. Private equity specifically, PSP ETF, you can see it's even tighter. And so what this kind of implies to me is that there are certain parts of the market that are really struggling right now due to the lack of the liquidity that's in the marketplace. And you can see that in the PSP, and you can even see that to some degree in the KRE. So I think that there are parts of the market that are being affected, and I think that's why you're seeing such poor breadth in the marketplace also. And so I think that right now you haven't really seen that in the index, but I think we're going to start seeing that in the index, because not only have we the liquidity issue going on hand, but if you remember a couple of weeks ago and months ago, we were talking about how low 3 month realized 3 months realized volatility had become, and basically the association with this low 3 month realized volatility and when it typically occurred. It occurred during periods of time where you saw either no real market movement, such as in here, or you saw these blow off top happen with big declines in the marketplace in January of 2018, in October of 2018, and January of 2020. Well, lo and behold, we come to today. Here you see 3 month realized vol came down really low. We saw this big move up in the S&P 500 the last couple of days. Notice the same exact thing happened in this case too. You saw 3 month realized vol really rise, the S&P come down, get the blow off top. In this case, you had something similar, big move. You got a little bit of a move down, another move higher. Realized volatility begins to rise ahead of the decline. And here's the same thing, similar type of mechanics. Index begins to really rise, realized volatility starts to rise, then you get the big sell-off. And so that's exactly where we are right now from that realized volatility standpoint. On top of that, we've talked a lot about implied correlations and dispersion. And what we do know on top of this is that the dispersion index, the DSPX, has actually started to begin to come down. The reason why the dispersion index is starting to come down is because all the big companies have reported results. All of the mega cap companies have now reported, and the only company that remains is Nvidia, but they're not going to be reporting for a couple of weeks. So if you take implied volatility of Amazon, what you see is that implied volatility of Amazon has now fallen sharply now that the company has reported results. If you look at the VIX on Google, also implied volatility is coming down sharply. If you look at the constituent volatility index, that's also starting to come down sharply. And that's because all the implied volatility in these single stock names is starting to drop, because what's basically happening over the last couple of months is you've had a volatility dispersion trade take place. And this takes place basically every single quarter, about 1 month before companies really begin to report results in earnest. And we are now past that point. And you could see that pretty clearly right now, right here, where the VIX index was basically trading sideways, but at the same time you had the VIX constituent volatility trading sharply higher. Now what's likely to happen is that this VIX constituent volatility level is going to start coming back down, back to where the VIX index is. And you can actually notice that the VIX index has been rising while constituent volatility has been coming down. That's because the dispersion trade is unwinding. Implied volatility dispersion is when you go long single stock volatility and you go short index level volatility. So now what needs to happen is that the single stock volatility needs to be sold and the index level volatility needs to be bought back. And so you're seeing the two begin to converge, and that's leading to the dispersion index coming down. And so what we know is when dispersion starts to come down, implied correlations begin to rise because the market will beginning to act more similar to one another, meaning that single stocks will begin to move more in line with the index. And so when implied correlations start to rise, dispersion comes down. And when you take the dispersion index and you minus the 3-month implied correlation index, what you get is a chart that looks like this. And when you overlay that chart with the S&P 500, you can see that it gives you a really good sense of the direction of the index, because the index tends to move in a similar direction to what this spread moves. And essentially what this is telling us is that we should really be starting to see the S&P 500 come down. So right now we have two things, I think, going on in the marketplace. One is we have liquidity levels that are very tight. They're going to ease a little bit this week, but I think the conditions are there. They're not going to be changing for some time. I think we're going to be in a tighter liquidity environment now until such a time that the Fed begins to expand the balance sheet, which I think is going to be some time. And then we're also in a period of time right now where these mega cap names, which have been kind of rising, are now going to be going the other way, because these dispersion trades are going to be starting to get unwound. And I think you're just obviously at the very beginning of it, because the big companies just reported on Wednesday and Thursday nights. And so we're starting to see this process unfold. And what's been happening in the rest of the market that's been kind of ignored in the major mega cap names and in really the S&P 500 index, the market cap index, is going to begin to start being felt. Anyway, please remember to subscribe to this channel, like this video, share it with your friends. I go over this type of stuff every day in the member area. It's a little bit more detailed. You're getting it more on a real-time basis. But again, this is like a lot of fun stuff, and we're super excited to see how this all unfolds over the next couple of weeks. Anyway, have a great rest of your weekend, and we'll see you again soon. Bye.